Good evening and welcome. I'm Mamta Rawat from the Corporate Communications team of CareEdge. I welcome you to our discussion today on India Inc. holds ground as global tariff war looms. CareEdge Ratings Credit Quality Assessment for H2FY25. We sincerely appreciate your joining us for this webinar. We would like to welcome our esteemed guest speakers for today in an alphabetical order. Mr. Ajendra Kumar Agarwal, Managing Director and Promoter at GR Infraprojects Limited. Mr. Akhil Jindal, Group CFO and Head Strategy at INOXGFL Group. Mr. Amit Talgeri, Group Chief Risk Officer at Axis Bank. Mr. Ashok Sharma, Deputy Managing Director, Chief Credit Officer and Chief Sustainability Officer at State Bank of India. And Mr. Nitin D. Parekh, Chief Financial Officer at Zydus Lifesciences Limited. This session will be moderated by Mr. Sachin Gupta, Executive Director and Chief Rating Officer at CareEdge Ratings. We will commence this session with the presentation by Ms. Smita Rajpurkar, Director at CareEdge Ratings. This will be followed by a panel discussion and a Q&A session. In case of queries, participants are requested to key in your panel. We will take up your queries at the end of the discussion. Now, may I invite Smita to make the presentation.
Thanks, Mamta. Hello, everyone, and a warm welcome to CareEdge Ratings webinar on credit quality assessment for the half year ended March 25. We will in the webinar share our insights on the credit quality of CareEdge Ratings rated portfolio and the rating movements during the second half of the last fiscal year amid the global economic uncertainties and the looming tariff war. Let's begin with the highlights of today's presentation. Global economic growth continues to be subdued amid geopolitical tensions and trade uncertainties. Domestic GDP growth has been tepid in FY25, albeit with some signs of recovery seen in Q3 FY25. In this backdrop, CareEdge Ratings credit ratio, that is, the ratio of upgrades to downgrades, strengthened to 2.35 in the second half of the last fiscal from 1.62 in the first half, with upgrades surpassing downgrades across the rating spectrum. Credit ratio of the infra sector continued the upward trajectory at 3.94 times in the second half from 3.50 in H1 of FY25. Manufacturing and services sector saw an upswing with credit ratio at 2.06 in H2, up from 1.21 in H1 FY25. BFSI credit ratio, however, took a hit, dropping to 1.07 in H2 from 2.75 in H1 FY25, with the sector witnessing challenges in specific asset classes. Persistent global challenges, including the impending tariff war and ongoing geopolitical tensions, continue to pose significant risks. We will now walk you through the economic landscape. Let us first discuss the global economic scene. Global growth is projected at 3.3% in 2025 as well as in 2026, which is still below the pre-pandemic long-term average growth of 3.7%. We have seen the US implementing high tariffs on trading partners, and further reciprocal tariffs are also anticipated on other countries based on the tariff differentials. Imposition of tariffs and counter tariffs is thus expected to hit global trade. Major central banks have started rate cuts. Rising trade tensions are fueling fears of stagflation in the US, marked by sluggish economic growth and high inflation. The ongoing geopolitical tensions, global tariff war, and growth concerns in China can thus impact the supply chains, trade, and commodity prices, and will remain our key monitorables. GDP growth has remained subdued in FY25, as we will see in the chart that will follow. Private consumption expenditure saw a recovery in the December 24 quarter. High-frequency indicators like GST collections and e-way bills generation also showed growth in FY25. Income tax relief and falling inflationary pressures should also support consumption demand going ahead. Muted investment growth and growth in manufacturing activity remains a cause of concern, while uptick in public capex should support growth in coming quarters. Core inflation remained largely benign. RBI cut the repo rate by 25 bips in February, with further cuts of 25 to 50 bips expected in FY26. However, unless this translates into reduced interest rates for the corporates, the impact will remain limited. Let us now go through some indicators on the domestic economy. As we discussed already and can see in the chart, GDP growth has remained tepid this year compared to last year, but a recovery is seen in the December quarter. We thus expect GDP to clock a 6.4% growth for the full fiscal of FY25 and 6.7% for FY26. In the right chart, we can see The private final consumption expenditure also recovered in December 24, supported by encouraging rural demand, while urban demand scenario remained mixed. Investment growth lost momentum in the December quarter, signaling a tempered investment climate amid the uncertain economic landscape. Bank credit growth also saw a moderation. In the left chart, we can see slowdown in the credit growth across the board with a sharp dip in credit to the services sector, which includes loans to NBFCs. Loans to the industry has also moderated, but the dip is marginal compared to other components. The CD ratio, however, remained elevated at 80.5% in March 25 as deposit growth continues to trail credit growth. Recent measures like injection of liquidity by RBI, deferment of LCR, that is liquidity coverage ratio norms, and restoring risk weights to NBFCs should support credit growth. In the external sector, we can see that FX reserves declined sharply since September 24 due to RBI interventions, albeit remaining comfortable with an import cover of 11 months. Net FPI outflows from equity markets since October 24 stand at approximately USD 25 billion, driven by global risk-off sentiment, putting pressure on the rupee. In this backdrop, the risk from US reciprocal tariffs and the ongoing global trade war is staring at us, and we will now try to assess the impact of the tariffs. President Trump has already announced several tariff measures, including sectoral tariffs announced on steel, aluminium, and automobiles, with other industries, including semiconductors and pharma, also under the radar. Further, details of additional tariffs are also to be unveiled today, and the exact impact of these measures is unfathomable. But we have attempted to simplify the impact of the tariffs on our GDP while recognizing that there are many moving parts and the true impact is difficult to predict. US is India's largest export destination, accounting for 18% of India's total exports, with aggregate trade exports to US at approximately USD 78 billion. Considering the tariff differentials, rupee depreciation, and a perfect price elasticity of demand, net impact on the additional tariffs can be worked out at about 4%, which is USD 3.1 billion. That comes to 0.1% of our GDP. Additionally, there will also be an indirect impact on India as the tariff war reshapes global trade and creates instabilities in the external environment. So, while the direct impact of the tariff war on India is expected to be limited, the indirect impact would be higher and sectoral exposure to the tariff challenges would be varied, which we have tried to analyze in the next slide. In this slide, we have tried to dissect the likely impact of the tariff war on sectors with high exposure to the US, including electronics, gems and jewelry, textiles, chemicals, and pharmaceuticals. In this chart, we have plotted the tariff differential of the export-driven sectors against the value of exports of these sectors to the US. The sectors highlighted red are expected to have a high impact of the tariffs as these are driven by discretionary demand like gems and jewelry. In case of electronics, alternate low-cost sourcing options like China could be explored, and the extent of impact would depend on India's relative cost competitiveness. Sectors highlighted amber like chemicals, textiles, agri-products, and auto are expected to have a moderate impact. Agri-products have a high tariff differential, but overall exports to the US are moderate. Exports of chemicals to US are very low, and imposition of tariff can impact demand or pricing, especially in basic chemicals. However, if higher tariffs are imposed on China, being the largest chemical producer globally, it may be beneficial to India. In textiles, the share of exports to US is quite significant, comprising cotton-based garments and home textiles, and the players may have to absorb higher tariffs. However, given the relatively low tariff differential, overall impact is expected to be limited. Similarly, in pharmaceuticals, India caters to the generics need of the US in a cost-effective manner, making it less likely to be impacted as any tariff imposed can be passed on. The overall economic landscape thus remains cloudy, with the domestic economy holding ground, but the potential impact of the impending global trade war looming large. In this backdrop, let us now move to discussing the performance of our rated portfolio in the second half of fiscal 25. The chart shows CareEdge Ratings credit ratio over the last 10 years. Credit ratio is the ratio of upgrades to downgrades in the portfolio reviewed during that particular half year. CareEdge Ratings credit ratio for H2FY25 saw an uptick to 2.35 with 386 upgrades and 164 downgrades. Let us now deep dive into the buildup of the credit ratio across various portfolio cuts. This chart depicts the credit ratio trend line for our investment grade, that is IG, and below investment grade, that is BIG, or sub-investment grade entities. The investment grade entities are entities enjoying ratings of CARE BBB minus and above. The credit ratio for the investment grade portfolio witnessed an upswing to 2.70 in the second half from 1.90 in the first half of the fiscal. The below investment grade portfolio also performed better, with the ratio inching up from 1.12 in H1 to 1.75 in H2. We thus saw a healthy momentum in the credit ratio in this half after the below investment grade ratio witnessing a significant dip in the last half year. In this chart, we can see the proportion of upgrades and downgrades across our various rating categories. The trend of upgrades surpassing downgrades can be seen across the rating spectrum. In fact, the proportion of upgrades vis-a-vis downgrades in the higher rating categories of AA and A is visibly higher than in the lower rating categories. This slide shows us the percentage of upgrades and downgrades to the total rating actions over the years. As we can see, the percentage of upgrades inched up from 12% in H1 to 14% in H2, while the percentage of downgrades declined from 8% in H1 to 6% in H2, resulting into an overall uptick in the credit ratio. Overall, the portfolio has remained stable with 80% of the ratings being reaffirmed. The strength of our rated portfolio is derived to a large extent from deleveraged balance sheets of the corporates. So, to see whether this extends to a larger sample of companies, we collated the available data on top 1000 listed companies by market cap for the last 10 years and arrived at the total debt by EBITDA and debt by equity of these companies. And the ratios clearly show a noticeable deleveraging trend over the last 10 years, with the total debt by EBITDA strengthening from 2.81 times in March 15 to 1.59 times in March 24, and the debt to equity improving from 1.3 times in March 15 to 1.07 times in March 24. We believe that the leaner balance sheets will allow corporate India to tide through the tough global macroeconomic scenario. We also attempted to assess the credit health of the corporates over a period, and a good indicator of the credit health would be the defaults from investment grade. So here we have aggregated defaults from investment grade entities across the four major credit rating agencies based on market share for the past 8 years, and it clearly shows a marked improvement with defaults falling from over 100 across the agencies in the period from 2018 to 2020 to as low as 9 in FY25. After this interesting metric and seeing how the ratio has performed across rating categories, let us now analyze the sectoral trends in CareEdge Ratings credit ratio. As we can see, the credit ratio for infrastructure sector is at 3.94, which has maintained an upward trend in H2FY25, driven by significantly higher number of upgrades in power and transport infra. The manufacturing and services sector credit ratio jumped to 2.06 in H2FY25 from 1.21 in H1FY25, driven by sectors including healthcare, capital goods, realty, and hospitality. The credit ratio for the BFSI sector moderated to 1.07 times in H2FY25 from 2.75 times in H1FY25. This was mainly driven by deteriorating asset quality and weak profitability of NBFCs in microfinance and unsecured business loan segments. Let us now study the reasons for the movement of the credit ratio across these broad sectors and our outlook. Starting with manufacturing and services, which accounts for the highest proportion of rating actions, that is 67% of the rated portfolio, and thus this sector has the highest bearing on the credit ratio. Uptick in the credit ratio of the sector during H2FY25 to 2.06, with 13% of the portfolio being upgraded and 6% downgraded, was primarily driven by strong performance of the domestic focused entities in the mid corporate segment, as also the large corporate segment remaining strong. Upgrade momentum continued in the key service sector entities like healthcare, realty, and hospitality, along with mid-sized entities in the capital goods and auto components and dealerships standing strong. In line with the past many years, the pharma sector continued to do well in H2FY25 as well. Upgrades were mainly driven by rising revenues, riding on strong domestic demand, and leaner balance sheets with capital infusions. Sectors which witnessed more downgrades were chemicals, especially entities in basic commodity chemical space, and small, less integrated players in the iron and steel industry, primarily due to pricing pressures arising from intense Chinese competition. This apart, small-sized trading and distribution entities and the export-focused textiles and cut and polish diamond sector also continued to see rating downgrades. Our outlook on the credit quality of the manufacturing sector remains stable on the back of sustained domestic demand and government spending on infrastructure. Service sector entities focused on domestic consumer spending are envisaged to continue to benefit. However, global headwinds persist and may keep private sector capex in abeyance till greater clarity emerges, while trade deals and rupee depreciation can provide some balm to exporters. We now move on to infrastructure. Credit ratio for infra remained buoyant, rising to 3.94 in H2 from 3.50 in the previous half of the year, with 20% of the portfolio being upgraded and a minimal 5% being downgraded, and a maximum upgrade seen in the transport infra and power verticals, as can be seen in the next slide. Upgrades in the infra sector were mainly seen in the transport infra and power verticals, with 27% and 19% of the rating actions being upgrades, with downgrades lying low. Key drivers for rating upgrades in these sectors include commissioning of projects, especially in the road hybrid annuity model segment, and solar power generation space, timely payments from state distribution utilities, resulting in faster than expected deleveraging for power producers and transmission infrastructure providers, and change in ownership to strong sponsors or InvITs, enhancing the financial flexibility. Downgrades in the space were due to company specific reasons like sluggish execution pace, weak order book position, and high working capital intensity, putting pressure on the credit profile of moderate sized EPC players and weakening of financial flexibility of specific project assets. Outlook for the infra sector remains stable, with enhanced revenue visibility in the transport infra vertical led by the government push. In power, thermal PLFs are also expected to remain range bound, with renewable tariffs poised to stay competitive, aided by declining module prices. In construction, diversified EPC players are poised to be better placed. However, slower order book additions in FY25 and increased working capital intensity are putting pressure on the credit profiles of mid-sized EPC players. Moving on to the banking and financial services sector, this sector, in terms of number of rating actions, constitutes the lowest percentage, that is 9%, and hence the sector as such has a low bearing on the overall credit ratio. However, since the number of entities are on the lower side, a few rating actions would be enough to move the needle of the sectoral credit ratio. Credit ratio for the BFSI sector deteriorated to 1.07 in H2FY25, reversing the rise reported in the previous half year. Upgrades were mainly driven by improvement in the parent credit profiles, while downgrades were driven by deteriorating asset quality and weak profitability of NBFCs in microfinance and unsecured business loan segments. Taking a closer look at the MFI sector, where we saw significant downgrades, the chart shows the trend in credit costs of around 10 MFIs over the past 3 years. We can see that the credit costs have moved up substantially from 2.6% in March 24 to 7.7% in December 24 and further to 8.1% in March 25. Downgrades in the sector were mainly on account of worsening asset quality, leading to high credit costs, rise in average ticket size of loans, and rising debt levels per borrower, accentuating the financial strain. Coming back to the overall BFSI sector, here we see that NBFCs saw the same number of upgrades and downgrades, while the upgrades in the banking sector was mainly on account of improvement in asset quality, capitalization, and profitability. NBFCs engaged in secured asset classes like home loans, loan against property, etc., continue to deliver healthy asset quality. With comfortable capitalization, outlook on the credit profile of NBFCs remains stable. NBFCs catering to microfinance and unsecured business loans are, however, expected to have elevated credit costs till H1FY26. Outlook for the banking sector also remains stable, with net NPA ratio for the banking sector at its lowest ever level of 0.6% at the end of Q3 FY25 due to continued improvement in asset quality and high provisioning coverage maintained by banks. With this, we come to the end of our presentation, and I will sum up with our view on the outlook going forward. We saw an upbeat credit ratio of 2.35 for the second half of the last fiscal, with manufacturing services and infra sectors leading the pack, while BFSI playing the dampener. The overall outlook remains stable for all the broad sectors. Potential supply chain disruptions, trade impacts, and commodity price fluctuations are factors to watch for manufacturing entities. Infra entities to remain upbeat on project execution strength and financial flexibility. NBFCs catering to MFI and unsecured business loans are expected to remain under pressure, but strong capitalization to act as an anchor. Credit ratio in the near term is thus expected to remain range bound, with geopolitical risks and impact of reciprocal tariffs to be the key monitorables. India Inc. thus held ground with lean balance sheets and minimal defaults amid the cloudy global environment. For more detailed coverage on each of the subsectors, please refer to our full report, which we will release on our website after the webinar. Hope the presentation was insightful. Let us now hear the views of our eminent panelists. Handing over back to Mamta. Thank you.
Thank you, Smita. Attendees are requested to key in their questions, which we will take up after our panel discussion. Now, may I invite Mr. Sachin to take over the session, please? Sachin Gupta serves as the Executive Director and Chief Rating Officer at CareEdge Ratings. With over 22 years of experience in leadership positions across the credit rating business, Sachin brings with him in depth knowledge of credit ratings across sectors, including infrastructure, financial services, and corporate sector. Prior to joining CareEdge, he worked as a senior director at CRISIL and managed the corporate and infrastructure ratings. He holds a bachelor's degree in civil engineering from Delhi College of Engineering and an MBA in finance from the Faculty of Management Studies, New Delhi. Over to you, Sachin.
Thanks, Mamta. May I request all the panelists to kindly switch on their videos and also unmute themselves? Great. So I'll do a quick round of introduction before we get on to the questions. So first of all, we have with us Mr. Ajendra Kumar Agarwal. He's the managing director and promoter of GR Infra, where he's responsible for overseeing the overall functioning, especially the operational and technical aspects. He acquired his degree in civil engineering from the University of Jodhpur and has over 25 years of experience in the road construction industry. A very warm welcome, Mr. Agarwal.
Sir, namaskar.
Then we have with us Mr. Akhil Jindal. He's the Group CFO and Head of Strategy at the INOXGFL Group. He comes with over 30 years of experience in engineering, corporate finance, banking, and M&A. Prior to INOX, he was with the Welspun Group for nearly 20 years, where he led acquisitions and divestments worth over $5 billion, and he also raised funds exceeding $10 billion. Mr. Jindal has done his BTech and is an MBA from IIM Bangalore. A very warm welcome, Mr. Jindal. Then we have, yeah, hi.
Thank you, Sachin. Thank you.
Yeah. And then we have with us Mr. Amit Talgeri, who is the Group Chief Risk Officer at Axis Bank. Mr. Talgeri he has been with Axis Bank since April 19, and his current role, he is responsible for strengthening the risk management framework across the different areas of risk. And in his 29 years of experience, he's had stints with multiple local and international banks in different areas of banking, primarily focused on credit and risk management. Hello. Then we have with us Mr. Ashok Sharma. He's the Deputy Managing Director and Chief Credit Officer and Chief Sustainability Officer at State Bank of India. His main role at SBI is to oversee the credit portfolio of the bank and setting up of policy directions. Prior to his current role, he was heading the project finance and structuring vertical of the bank. He was also the member of task force set up for establishment of NACFED. He is currently on the board of RSIL and NESL as SBI nominee. Hello, Mr. Sharma. Very warm welcome. And then we have with us finally our last guest, Mr. Nitin Parekh. He's the Chief Financial Officer at Zydus Lifesciences. He has over 4 decades of experience in finance, legal, IT, and M&A. He's a member of CFO Council of CII, FICCI, and ASSOCHAM. Mr. Parekh is also a recipient of more than 20 awards, including India's Best CFO by Business World in 2021. He also has a great passion for literature and music, and his 3 books of poems are published. He is a CA, CFA, and MBA from IIM Ahmedabad. Hello, Mr. Parekh.
Hello.
Great. So, I must confess it's a very, very illustrious panel, and I hope I'm able to do justice in terms of, interactions and value to our audience. But indeed, I must say that it's very interesting time. While, we do this exercise every 6 months of review of our portfolio and all that. But I think the most interesting thing is the upcoming Trump tariffs, as everyone seems to be scared of them right now. Coming later tonight. So, while we do not have the benefit, but yes, in our interactions, we will try and see, how the Indian corporates and the Indian banks are kind of looking at it in terms of, handling and managing that. So I'll start with Mr. Sharma from SBI. Sir, we have seen that, and which we covered in the presentation also, that the credit growth subsided in the last year. And, the deposit growth has also been subsiding, or it's not really been as much as we would want. And therefore, there is a general pressure on CD ratio, and which is kind of leading to an impact on NIMs, etc. So, can you give us a sense of how you see the credit growth happening, and also from a profitability perspective for the banking sector, how do you see that panning in, say, the next 12 months or so?
Thanks, Sachin, for having us here, and good afternoon, everyone. See, as you rightly said, the deposit growth has been slower, ranging the 8 to 9% segment in the bucket, and similarly, the credit growth also in the similar segment. We're trying to look at whether the incremental deposit growth is able to cover the incremental advances. The answer is positive. So that way, the pressure on the NIM is contained. Now, coming back to the how the this repo is impacting the NIM. See, if you look at it, the composition of the bank's liabilities, so you'll find that CASA is roughly in the range of 40%, and then other liabilities are 60%. So
Correct.
CASA is able to get repriced much faster, savings bank, etc. In the other category, there is a significant component, the bulk deposit. So what we are seeing in some banks, that banks are now reluctant to take on the bulk deposits. So this is the way they are handling their ability to probably right price the deposits. So to probably manage the NIM. On the asset side, if you look at it, uh, roughly 50% of them, mostly retail loans, they are what we call the EBLR linked, external benchmark linked. So the transmission is faster. The remaining ones, which are MCR linked, has a late transmission, if I put it that way. So in that sense, some lag would always be there. Something like when you look at any manufacturing company, raw material price increase, so some lag is there. But is that lag is going to significantly impact the NIM? My understanding is no. See, primarily, if you look at the public sector banks, the NIM has been hovering around 3%, private sector around 4%. That has been the range typically. So it is going to remain in that range. I do not see a very significant impact on that. So maybe couple of
Got it.
here and there, but
Yeah.
broadly the range would remain. Yeah.
Yeah, and I think that's fine. The other thing in terms of credit growth, are you expecting it to kind of inch up now that RBI has kind of loosened some of the risk weight kind of actions that they had taken a year and a half back?
One part is I'll put that way. RBI has some role in that, but more role is like my friend Mr. Ajendra from GR. So if they do lower a lot more capex, then the growth will be more. But having said that, let us look at the composition of the industry. See, earlier you were saying that some core sectors, steel, cement, infra, they were working. The new sectors not going to the market, but if you see in last 1 year or 2 years, new sectors coming to the market. We are talking of semiconductors, we are talking of so many other things. So that means we close one sector and we open another sector. So there's a good thing happening in the economy that earlier we were talking of limited core sectors, but as you move forward, you improve your quality in the economy, then more new sectors are getting added up, and because new sectors are getting added up, the growth momentum remains. I would not say it will be very high, but it continue
Got it.
to be at a significantly acceptable level.
Got it. Got it. Certainly makes sense. Let me get from the corporate side, Mr. Parekh of Zydus. And that is, I would ask the question which everyone seems to be asking. How do you see the pharma sector, getting impacted by whatever the imaginary or the expected Trump tariffs as they are now likely to be imposed? How are you seeing it? And how are you kind of protected from any adverse actions?
Yeah, that's a very interesting question, I think. And thank you for this opportunity to be part of the panel. As we've been hearing for last couple of months, President US is talking about reciprocal tariff on pharmaceutical products. But if you look at the statistics, then as of now, the import duty rate on imports from US is not more than 10%. Again, there are many products where the rate is 5%, and there are about 150 products which are completely exempted from import duty. So what it means that the blended rate on import from US pharmaceutical products is less than 10%. And if you look at the value of import from US in terms of pharmaceutical is about 800 million US dollar. When you compare this with our export, which is about 8.7 billion US dollar, then if the real testing ground comes, and as your title itself suggests, we are holding the ground as of now. But if the real need comes where the duty is actually on a reciprocal basis to be reduced, then I think the government, in all probability, will consider reduction of or removal of that duty so that a large Indian pharma industry, remains in the pink of health. Having said so, let's also envisage the situation that when Donald Trump mentioned about this pharmaceutical import, he is also referring to imports which is happening from Ireland, the Tax 7, and some manufacturing which is taking place in China. So if you look at the Ireland exports to US in the year 2024, it was to the tune of euro 44.4 billion. And therefore, it is also possible that while the generally tariff is talked about, the products which like generic and some biosimilar which contribute to only about 13% in terms of value, but 90% plus in terms of prescriptions may be spared. And there's also economic reason for that, because what we have found on a year-on-year basis, there are about 125 to 175 products which remain in shortages in US. And if the tariff is to be levied and if it is to be borne by the manufacturers like us, then some of the products will go out of the manufacturing because of the profitability issue. And on the other end, given India's strength in terms of the cost competitiveness, India and players like Zydus may actually gain compared to some players, let's say in other countries like Israel or Switzerland or other countries, right? So that is also likely situation. Having said so, how the pharma companies are looking at this currently? So it is a wait and watch game right now. We also believe that maybe 50 to 80% of the tariff, if at all it is levied, can be actually passed on to the consumers or to the distribution, channel partners. And there could be product-specific pricing strategies. You reduce the prices somewhere, you increase the prices somewhere. The game also, given our cost leadership, can be in terms of gaining market share. We can gain the market share. So ultimately, when you look at the price into Q, you may still gain in that particular matrix. And the last part, which is much talked about, that whether people will start manufacturing in the US. While some players may consider if they already have some presence, but most probably not. There are in specific regions. For example, it may take 3 to 4 years in terms of getting regulatory approval of plant. The capex is very costly. The OPEX can be 2 or 2.5 times. And in India or other countries, wherever the current manufacturing facilities are there, they are quite spread at different locations. So it's not very easy to move the facilities and close the facilities here, start manufacturing facilities there.
Got it.
So I think
Got
it's
Yeah.
interesting time.
Yeah.
Let's wait.
Yeah, and in fact, I mean, for pharma at least, even our analysts feel that the impact will be much less than maybe some of the other industries. Let me get Mr. Jindal. And same question, sir, to you. How do you see this whatever reciprocal tariffs, Trump tariffs, on the chemicals? You are in specialty chemical space, so what's your sense? How that industry is likely to be impacted?
Yeah, thank you, Sachin. I guess from a chemical perspective, we can only say that there would be more positive development as far as the Trump tariff is concerned, because they are going to be more targeted towards China than us. And naturally, on the EV battery side, the chemical side, there are no players outside China who are equipped to make these products, which are say LiPF6 or LFP or say PVDF, cam binders, other things. So to that extent, I think there is no linkage with this Trump tariff. As far as the basic polymers are concerned, again, those are not manufactured in US. Those are coming from outside. So in all probability, many of these things are something that we would be, we as a country should be benefited. And certainly, GFL and GFL EV will be a direct beneficiary of these tariffs if they come up.
Got it. Got it. So quite an optimistic view, I must say. Let me get Amit. Amit Talgeri from Axis Bank. How if I look at the overall banking sector, the credit cost per se are at one of their lowest levels ever. Now we are seeing some inching up of the credit cost, across some bit of retail, some bit of unsecured, which we also discussed in our presentation. How are you seeing, from where you sit, how is that credit cost? Are they in general likely to inch up? And if you can maybe give some flavor of how you are seeing the impact of the Trump tariffs as well, how do you see that impacting the credit quality of your portfolio?
Sure. So first of all, thanks Sachin for having me on the panel. I hope you can hear me loud and clear.
Absolutely, loud and clear.
So
Yes.
first and foremost, you're right. Absolutely, I think credit costs have been coming off a trough, for the last few years. In fact, meaning that what you see last year probably is not representative of a through the cycle kind of credit cost. And to that extent, I think the credit costs for the system in general cannot be at the same levels as what we've probably seen in the last couple of years. In a sense, the credit costs are probably inching upwards towards what I call normalizing in a cycle. And I think you did mention the macro conditions do remain tough. So it's not that we are going to suddenly see a big sea change in the next few years, etc. I think the other thing we are seeing is, largely if you look at where those credit costs have been inching up, they've been primarily around the retail space and in the unsecured space primarily. Corporate earnings typically have been moderate to robust. Actually, I should say robust to moderate, probably inching down a little in a sense in the last couple of quarters, at least the way we've seen it. But on the retail side, we generally see some amount of an inching up, especially if you look at information provided in public domain by bureaus. We've seen unsecured delinquencies having inched up quite a bit. And to that extent, we don't know if the cycle is something that we've already seen through it, or we are probably in the process where they are still stabilizing. And I would like to believe that while there are signs that things have got a little better in the last couple of quarters, but we would like to still say we probably need to see some more stabilizing on, in terms of the numbers. But overall, if you really look at it, I think the muted earnings on the corporate front will probably have some impact on balance sheets. But the good news is that a large number of corporates, have strong balance sheets, have deleveraged. You've seen that in your presentation also. And to that extent, we don't see too much of an impact in terms of the large corporates. However, there could be some amount of a second order impact in terms of maybe the smaller MSMEs, for example, or micro enterprises. So if you look at it, would there be a contagion in that sense of what's happening on unsecured spreading to MSME? Probably likely not. But there could be some elements which you probably need to be a little more cautious around. And of course, like I mentioned earlier, the macros are something that we probably need to be a little watchful about. There could be some sectors which you could see sector-specific issues coming up in terms of stress over the next 12 to 18 months. And that's something that we need to be careful about. So in summary, I would probably say that the current phase is more about normalization in a credit cycle. And probably the last 2-3 years are not, in a sense, indicative of real-time credit costs is how I would probably put it.
Got it. Perfect. Thanks, Amit. I'll come to Mr. Agarwal from GR. One of the things that we are now talking about is how India can be more competitive. If it is almost forced to open up and reduce its duties, etc. We need to be competitive compared to other countries to be able to sell our products. And in that, one of the things which people a lot of times talk about is the cost of logistics. And since you have a ringside view of roads and other sectors, what do you think? Are we India as an economy? Are we cost competitive if we were to look at logistics as an area? And do you think there are scope for us to reduce the cost of logistics so that we can become more competitive?
नमस्कार सर, थैंक यू सर। ग्लोबल सिनेरियो में देखते हैं अपन, तो लॉजिस्टिक कॉस्ट जो है वो अराउंड 8 to 10% है, और इंडिया में ये 15 to 16% है, इवन कुछ जगह इससे भी ज्यादा है। अब ये स्कोप की जहां तक सवाल है, वो तो स्कोप तो क्लियर है कि अपने को 16 to 10 और 9% पर लेकर आना है, तो स्कोप इज क्लियर। और जब लॉजिस्टिक के ऊपर अपन जब बात करते हैं, लॉजिस्टिक कॉस्ट के ऊपर बात करते हैं, तो सबसे बड़ा इंफ्रास्ट्रक्चर रिक्वायरमेंट आती है वहां पर रोड कंस्ट्रक्शन की, जिसका एक लेवल तक अपन ने कंस्ट्रक्शन किया। हालांकि इसके अंदर काफी आगे तक जाना है, इसमें काफी कुछ काम अभी भी बाकी है। जो ग्रीन हाईवेज अपन ने अभी स्टार्ट किए हैं उसकी 100% कनेक्टिविटी अभी होना है। जैसे दिल्ली बॉम्बे कॉरिडोर है तो वो उसके 80% कंप्लीट है, लेकिन अगर वो 10% भी अनकम्प्लीट है तो 100% उसका यूटिलाइजेशन नहीं है। अभी पीस मिल में उसका यूटिलाइजेशन हो रहा है और उसको आगे तक और कंप्लीट करना है और उसके ऊपर अपन काफी अच्छा काम कर रहे हैं और करेंगे। लेकिन उसके आगे की जो जर्नी है उसके अंदर काफी कोऑर्डिनेशन की रिक्वायरमेंट है। ये मल्टी मॉडल लॉजिस्टिक पार्क डेवलप करने हैं, इंडस्ट्रियल पार्क डेवलप करने हैं। अभी हाईवे बनाते वक्त केवल एक नोडल एजेंसी एनएचएआई थी जिसने अपना काम किया है, लेकिन अगर मल्टी मॉडल लॉजिस्टिक पार्क में आएंगे तो उसमें काफी एजेंसियों का इन्वॉल्वमेंट आएगा, स्टेट गवर्नमेंट का भी आएगा, इंडस्ट्रियल बॉडी का भी आएगा और इवन रेलवे का। तो इन सभी बॉडी का कोऑर्डिनेशन एक बड़ा चैलेंज है। ये जब तक कोऑर्डिनेशन अगर प्रॉपर हो तो इसमें इंडिया में अभी ये काम किया जा सकता है और इसका स्कोप बहुत जबरदस्त है। अब जहां तक सवाल है सर इंटरनेशनली कम्पिटिटिव होने का, मुझे ये समझ में आता है कि जो बिजनेस है वो हमेशा बिजनेसमैन के लिए चैलेंजिंग रहा है, गवर्नमेंट के लिए कभी भी चैलेंजिंग नहीं रहा। इंडिपेंडेंस से अगर आप देखें तो गवर्नमेंट तो अच्छा ही काम कर रही है। गवर्नमेंट ने कभी ये कहा है क्या कि मेरा काम अच्छा नहीं है? चाहे किसी भी पार्टी की सरकार हो, कोई भी पार्टी हो, कभी भी वो ये नहीं कहता है। उसको चैलेंज करने वाला कोई नहीं है। गवर्नमेंट को कोई भी चैलेंज नहीं कर सकता। कोई बिजनेसमैन जाके गवर्नमेंट को चैलेंज नहीं कर सकता कि आप काम अच्छा नहीं कर रहे। उसको चैलेंज करने के लिए इंटरनेशनल बॉडी है सर। हिस्टोरिकली देखें तो इंडिया के सामने 2 बार बड़े चैलेंज आए। 90s में बैंक्रप्सी का चैलेंज था नरसिम्हा राव गवर्नमेंट के। उस टाइम जो काम हुआ आज तक की इंडिया की हिस्ट्री में बेस्ट काम हुआ है। इंडस्ट्री के लिए सबसे जो ओपननेस आई उस टाइम आई। सेकेंड टाइम जब अटल बिहारी वाजपेयी गवर्नमेंट ने एटॉमिक पोखरण जब किया, जब सभी इंटरनेशनल बेंच लगे, उस टाइम गवर्नमेंट के ऊपर चैलेंज आया। उस टाइम जो ओपननेस आई वो सबसे हिस्टोरिकली है सर, ये दोनों इवेंट। और अभी ये थर्ड है, ये थर्ड हिस्टोरिकली इवेंट होगा इंडिया के लिए और इंडिया इस चीज से ऊपर निकल कर आएगा, ये कंफर्म है सर। ये इंडस्ट्री के लिए बेस्ट इवेंट होगा। इंडस्ट्री जो चिंता कर रही है उसके लिए बेस्ट इवेंट होने वाला है। और इंडिया अगर 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 काम किया सबने मिलके तो इससे बड़ी अपॉर्चुनिटी नहीं हो सकती। ये
या No, no, आप एकदम सही बोल रहे हैं. Thanks a lot for that confidence. And I agree with you that when there is a challenge, तभी लोग ज़्यादा solutions ढूंढते हैं and threat can become an opportunity. जो जैसे अभी लग रहा है कि and that's what you are also saying.
जी सर.
Great, sir. Thank you for your thoughts. Let me come to Mr. Sharma. Sir, what is your sense? You have you being the chief credit officer of the largest financial institution of the country. From where you sit, are you worried on the Trump tariffs across some sectors or overall as a systemic thing?
Not really, because one good thing about our economy is we are almost self-contained. So if you look at the consumption pattern, our domestic consumption is very high, and except couple of sectors, if you leave around, most of the production is linked to the domestic consumption. And even those sectors, for example, pharma, where we have a good export market, there are opportunities wherein we can, as Mr. My colleague Mr. Nitin Parekh was mentioning, we have a good case that ultimately the US may get impacted, not us. So as a bank, we do not really see that in longer term this tariff is going to get impacted, but of course we have to watch out, then play our game accordingly. That is what I wanted.
So wait and watch in some ways.
Yeah.
Okay. Let me get Mr. Akhil Jindal. And similar to what I was asking Mr. Ajendra Agarwal, the whole thing is about ease of doing business. And since you also look at a portfolio of renewable projects, wind energy projects, how do you think things are improving, say in terms of getting land or right of way, grid connectivity, etc.? Do you think that we are making that difference? Because increasingly we will have to be more and more competitive, and cost of electricity is again a reason for people to be, for the industry to be able to be more competitive. So can you share your thoughts on that?
Yeah. So Sachin, as renewable energy, we have already reached to the lowest tariff regime. What it means is that if anyone is putting up a hybrid renewable project, he is able to get almost 80 to 90% assurance on his energy needs on the round the clock basis. And if tomorrow the battery can also add up, which is fastly improving, he can have a 100% solution. The weighted average tariff for such initiative is somewhere around, without the battery is around 3.5 rupees, and with battery probably around four and a quarter. What it means is that this is already the cheapest source of energy in comparison to thermal, coal, gas, nuclear, whichever other source of energy that you can deem appropriate. This is already the cheapest source of energy, and it is green. So to that extent, I guess there is an automatic tick mark. Yes, there are challenges in the right of way. There are challenges in connectivities. There are challenges, particularly in the wind sector, because these are where you have to go to the wind sites. Unlike solar, which could be put at any place, wind have particular sites, and those are places where one has to be able to reach, and one has to be able to provide the energy solutions. But I think today with the connectivities, the government initiatives on the CTUs and the state grids also becoming more and more robust, I think even that challenge is being addressed. The amount of PPA that are being signed in this sector are obviously, in the last one month itself, roughly around 18 to 19 gigawatt of the PPAs has been signed in the March, say late February, March month. And the government is extremely conscious, and they are absolutely behind this sector, because they know that in a longer term, from a time perspective, see, if you plan a thermal project today, it is easily a 5-year process. I mean, if right from the beginning to the end, while the renewable energy can come in a very short period of time. I mean, it usually takes not more than 12 months for the full construction to be over and the energy to be generated. So I think from a governmental push angle, from the ease of doing business, from other aspects, this is certainly a sector which is getting a lot of support. Plus the domestic content requirements that are coming up for the manufacturing, whether for in way of an ALM for the solar or RLM for the wind turbines, is also something that is helpful for the industry. And in any event, every business has an agenda to move to the renewable energy from their existing captive production, whether it is a coal based or a gas based, as the case maybe most of the cases. So there is a complete, I would say, support to this industry, and naturally the government is aware of the opportunity and also the requirement for the country. And there's a probably the fastest solution.
Yeah. So very true. And in fact, I think renewable energy is one of the big success stories for the country in the last, I would say, 5-7 years. And again, being cost competitive and green. So yeah, and with if the as you mentioned, battery solutions can be there, then it can really be the then we don't need any other form of electricity source. So great, yeah. Thanks for that. I'll come to Mr. Parekh. One of the things in pharma that is often spoken about, and maybe it will be good if you give some clarity on that, is that we are over dependent on China for the key starting materials and APIs, etc. And in this whole thing of the tariff war, if it kind of blows up into a global thing, do you see Indian pharma players being at the mercy of the Chinese players, and therefore that kind of some challenges could come and create a supply chain issues for us?
So as of now, yes, there is dependence on China with various government efforts and the strategies adopted by Indian manufacturers. We have been able to reduce that dependence to some extent, but still the dependence continues. So what companies like us are following is what we call China plus one strategy, means developing alternate sub vendors, Indian vendors or non-Chinese vendors from certain European countries and also from Taiwan. Certain APIs and KSMs we are able to get. The second part of strategy is going for backward integration. Like in Zydus, we have almost 50% plus of our API requirements met by our own in-house manufacturing of APIs. Having said so, still for intermediates and some KSMs, dependence remains. PLI scheme has been helping to some extent in this respect, and for some of these, specific products which are considered critical by government and listed under PLI scheme, including penicillin, cephaloxivin, some statins, and steroids. So there we have been able to make progress. The impact of this is seen that there is now some kind of stability in the prices that we are getting compared to what kind of issues we are facing, during COVID time. Apart from the logistic cost, even in terms of input cost, I think there has been a stability because now the Chinese suppliers also understand that if not today, tomorrow, certain products are going to be manufactured in India, so they must behave. So there is some reduced dependence on that, but on the whole, if I say it's still a mixed bag, I can't say that we have been able to make a significant progress on that. But yes, directionally we are on the right direction.
So there will be, we can expect maybe more investments, capital expenditure on the backward integration. I mean, more than what we have been doing till now. Do you think the industry will move in that direction?
Something can happen, but I must say that on a comparative basis, the PLI scheme as it has worked for formulations, to the same extent it has possibly not worked for
Correct.
API.
Correct.
That also depends that whether we have Indian requirements or not. For those kind of inputs, if you come out with the plants which are only meant for global, market as a size, to become economically efficient, then only few players would have found the interest in that. Otherwise, people go for that when they have their captive requirements. So you are not on the same field as PLI scheme for formulations that way.
Got it. Got it. Amit, I asked this question to Mr. Sharma from SBI earlier. I mean, raising liability side resources for banks is, kind of at a forefront, which has never really been such a big challenge in at least the last 10 years that I can think of. But now for the last year or 2 years, it's becoming very, very critical, and more so for private sector banks. I think Mr. Sharma is, talking from a position of strength, because their CASA is, reasonably strong at 40%, even though it is coming down for almost all the banks, as we see, including the large banks. So the question that I have in my mind is that, if and banks are increasingly resorting to, infra bonds, etc., being AAA, they get good cost. But then there are also NBFCs which are able to raise money, and they don't have this requirement of SLR, etc. So they can, maybe use the entire money for lending, etc. So how do you think, is the competitive advantage of a bank being able to raise cheap funds and invest or lend to large projects? Could that be at risk in some ways from a profitability and cost competitiveness perspective?
No, absolutely, Sachin. Good point. So let me start by first saying not at the same scale, but our CASA ratio is also in the similar range,
Okay.
but clearly not at the same scale. And there is no doubting the fact that there is an increasing challenge for banks on the deposit front. While there will always be a flight towards banks and top-rated banks, and especially when it comes to public sector and the large private sector banks, when it comes to household savings, we are effectively competing with other asset classes, and that's the real biggest challenge in a sense. So banks do have other sources of funds, in a sense. We do look at refinancing from development institutions, infrastructure bonds, bulk deposits, that he mentioned also earlier. But there are only some finite such sources. So it's not that it's endless money available there. So there is that cost competitive pressure as well. The banks are also looking at alternate sources in terms of foreign borrowings as well, right? Where if you look at borrowings, where from foreign currency markets, for example, or if you look at avenues through multilateral agencies. But they do come with their own challenges, end use, specific end use, disclosures, etc. And the good part or the bad part of it is that while they are great names to have on your books, but they don't give a great deal of pricing benefit and pricing arbitrage. So in a sense, you're back to square one in terms of trying to develop the homegrown CASA, franchise. There is no doubting that prime, household savings in the form of CASA will always remain the prime backbone of, a deposit strategy for the banks. And that's always going to be a big challenge. What we are also seeing is that increasingly we are also, in a sense, competing with NBFCs, right? In a sense, in that market, especially the top-rated NBFCs today have access to, similar funds in the marketplace. Especially, of course, their larger borrowings do come from banks, but they do have access to corporate bonds. They do have access to mutual funds, all of that. So increasingly, we are seeing deposits continue to remain a challenge. I think more than the banking system, I think we are looking at other asset classes that we are really fighting against, in a sense, and that's always going to remain a challenge in the current market. There is the regulator, of course, is doing a lot in terms of trying to inject liquidity to ensure there is enough and more in terms of to spur credit growth. But in general, there, at least in the last couple of quarters, we've seen moderation of credit growth, with a slew of regulations there. So we don't see that situation changing dramatically, and our own assessment is that deposits will continue to remain a challenge.
And therefore, even though there could be interest rate reduction, policy rate reduction by RBI, which people are now expecting and all that, but it may not really translate into lower borrowing rates for corporates and for retail borrowers. Is that a fair assumption?
Yeah, that's a fair assessment. I mean, and you can already see that, right? I mean, in a sense, when the rate change happens, the lending rate transmission is extremely quick, but the deposit rate transmission is very, very slow. And given what's the current market situation, there is, in a sense, competition in terms of the deposits market. So it's not easy translating that cost straight away. And to that extent, there is pressure in terms of the deposit transmission, in a sense. You're absolutely right.
Got it. I think Mr. Ajendra Agarwal may not be very happy with your comments that borrowing rates may not come down very soon. But Mr. Agarwal, let me come to a question. What we are seeing is that, while road sector for many years was the poster boy for infrastructure sector in the country, but last 2 years or so, we've seen some bit of both the awards of NHI have come down and also the competitive intensity from the bidders has gone up. And that kind of worries us because the sector has in the past gone through a bit of challenge where the developers got projects and then there were challenges and then there were defaults and etc. So how do you see that? I mean, are you satisfied with the way the bidding of NHAI? Do you think more bidding could happen, or is it, as we are seeing, most of the developers are now getting into other segments like irrigation, mining, etc., to kind of de-risk themselves from slowing road projects demand?
सर, अभी एनएचए की अगर पिछले 2 साल में देखें तो बहुत कम, मतलब जो अवार्ड जो है काफी कम हुआ है और ग्राउंड पे चैलेंजेस काफी बड़े हैं. इंफ्रा का जो जिस तरह से लाइमलाइट में आया, उसका ये नेगेटिव इफेक्ट हुआ कि बहुत सारे बिजनेसमैन इसके अंदर आए, बहुत सारे बिजनेस इसमें डाइवर्सिफिकेशन हुआ और कॉम्पिटिटिवनेस बहुत ज्यादा बढ़ गई है. अभी एक्चुअल में देखें ग्राउंड पे तो मतलब 30% तक माइनस रेट्स पे कोटिंग हो रही है, जो कि अगर किसी भी प्रोजेक्ट के अंदर देखें तो अपन 60% मटेरियल कॉस्ट है. तो अगर उस तरह से अगर एनालाइज किए तो आपके पास में प्रोजेक्ट वो क्वालिटी के साथ में बन नहीं सकते. लेकिन इंफ्रा का एक चीज है सर, जो इम्पैक्ट है वो 3 साल बाद में आता है. आज के दिन जो आप इंफ्रा देख रहे हो वो बिडिंग 3 साल पहले हुआ है. तो 3 साल 4 साल तो अभी आप हर चीज को अच्छे से देखेंगे, अच्छी शेप में मिलेंगी आपको. लेकिन अभी जो पिछले साल से जो बिडिंग हो रही है तो उसका इफेक्ट जो है अगले 2 साल में 3 साल में आएगा. तो अभी आपको इम्पैक्ट दिखने लगेगा. और दूसरा एक चीज और, जो आप फाइनेंशियली जो क्रेडिट रेट्स की जिस तरह से बात कर रहे हैं, बोरोइंग और लेंडिंग रेट्स जिस तरह से इंक्रीज, उसके लिए जगह ही नहीं है. क्योंकि जिन लोगों ने जो बिड कर रखे हैं इस तरह से टाइट मार्जिन पे कर रखे, अगर किसी भी तरह के इम्पैक्ट उनके ऊपर ट्रांसफर होगा तो सर्वाइवल मुश्किल हो जाएगा.
चलिए, सो अंडरस्टूड. आई थिंक यू आपने अच्छे से बताया है. आई एम श्योर देयर आर 2 रिस्क पीपल सिटिंग ऑन द पैनल, वो ध्यान दे रहे होंगे इसका. Let me come to Mr. Sharma. You also wear a hat of Chief Sustainability Officer at SBI. I mean, and there is RBI's draft requirements. They require disclosure of climate-related risks and progress over the last couple of years. But what do you think? Are the Indian banks and the corporates in general appreciative of this. Akhil Jindal earlier had mentioned that more and more people want to shift to renewable energy, etc. But is this still more of lip service, or are we seeing significant change in the way corporates are strategizing and thinking about their businesses and the projects?
Put that way. So Indian culture has been sustainable by nature. All of us have that. So whether we are able to translate that personal sustainability into the corporate sustainability, that is the question. We are seeing that large number of corporates are trying to set up renewables themselves. Uh, Cement companies, power, the steel companies,
Yeah.
so, and not only in megawatts, in gigawatts. So that means there is a sort of incentive in terms of the costing. You get the renewable for 2.5 if it is solar, 3.5 if it is wind. And otherwise, I think if you, let us say in Maharashtra, you get 9 rupees, 10 rupees.
Right.
So the cost competitiveness is simple arithmetic. So a lot of corporates are going for, particularly on the power sector. In the other areas also, we have seen a lot of corporates have come out very well. If you look at the SEBI guidelines, which warrants the top listed companies to put up the BRSR code, so large number of companies are already declaring a lot of good things. So I think that it is an in thing now, and the corporates, many corporates have appointed sustainability officers. So that's what we are seeing in the market. So it is a thing which the corporates are passionate about it, and I think we are ahead of the curve. I will put it that way, as a country.
Okay.
Yeah.
No, that's good, and I echo your views. A lot of large business houses are setting up. They've really committed large pools of capital because it's business. That's business. That's not so much only for governance or sustainability. It's pure business, and that is good. When business meets sustainability, I think that's the best way to kind of do it. So great. So we are now at about 5 p.m. We have about 12-13 minutes left in our time. I would like to now open the floor for the questions. Mamta, can you please make that announcement and open the floor for questions?
Sure. Requesting the participants to kindly drop in their queries. We will take up the question now.
So this first question has come, but I think this will have to be Smita. Are you there on the call? It says which subsectors in infra and manufacturing witnessed increase in the credit ratio in H2 versus H1? Can you please quantify the same? So maybe can you identify the sectors where we had a high credit ratio
Yes. So the
in both?
sectors
Yeah.
that did better in the infra sector were power and transport infra. These sectors have, anyways, we had even highlighted in our presentation for the sectors which have done well. In the manufacturing, it is realty, healthcare, capital goods, auto and auto components, agri and pharma and textiles. So these are the sectors which have done well in the manufacturing sector overall compared to the last half year.
Got it. And I would advise this is Sushant Vanmali. You can refer to our report which will be released that will have more detailed data there. Next question is from Nidhi Shetty. That's Mr. Parekh for you. It says, given that we have less bargaining power with US wholesalers in the pharma sector, how much of the costs will the Indian pharma companies will have to absorb?
So many of the products in generics ultimately, get discounted at the end, and therefore a significant part of the duties, if at all levied, can be passed on to the ultimate payers, and some part then can go to channel partners and balance to be borne by the manufacturers.
So can you take a guess? I mean, and maybe if you can take an example roughly. I mean, I understand what you're saying, but say if you're saying that if you sell the product for say 20 rupees, ultimately it will be sold at a much higher price, right? and therefore the margin is there in which it can be absorbed. Is that what you're saying?
Correct. So generally, there is a MRP based pricing and there is a chargeback, which is normally happening in the channels. So the chargeback amount, depending on the product and the competitiveness and other scenarios, can be even 75% of the MRP. Okay, as example. So what I may be selling, let's say, is 25. MRP can be 100 and 75 can be charged back. So the chargeback, a part of the chargeback then actually gets passed through pharmacy chains to the ultimate patients or the consumers. So if you move that little bit here and there, like for example on 25, if the 10% duty comes, it is 2.5. Now 2.5 to be absorbed out of the 75 is not very difficult. That is why I'm saying it's not very difficult to actually pass on this to the ultimate payers.
Got it. As long as it is not on the MRP, it is on the value of the exports that you are doing, and
Correct.
therefore it will be there will be enough window to absorb it.
Correct.
Got it. One more question we have is on the MFI sector. Rakesh Shetty, he's saying on the MFI front, you mentioned H1FY26 as the pain period. What credit costs are anticipated post that? So while I don't think we have really made a projection for this thing, but I think what we are broadly, directionally, I can share with you that while in the current year, the credit costs were in the range of 7 to 8%, which is quite a bit. I mean, considering it's a finance business, which is leveraged at least 3 to 4x, losing 7 to 8% of your book is quite material. We are expecting, and that is some bit of hope is also there, that the numbers will be lower, maybe in the range of 4 to 5%, because we do expect Q1 and maybe for some people Q2 will be there. From H2 it should start recovering, and therefore the credit cost could be 5 to 6% in the next year. But again, this is with a lot of assumptions and with a lot of inputs, because it's clearly a bottom of the pyramid lending which happens, and it could be exposed. And especially now in MFI, what we are seeing is the lenders have become more selective in lending, and therefore the access to funds for the ultimate borrowers is less, and therefore it's a bit of a tightening of the whole credit availability, and therefore it's difficult to say how much more pain come in. But yes, we are expecting some bit more of stress in the next 2 quarters or so. Amit, do you want to take anything on that? Further to that, what I've said on MFI?
I think Sachin, you've captured that well. I think what is important is that there needs to be some amount of stability before we decide that the worst is behind us. I think we've seen probably some stability, but we probably need to see some amount of sustained stability in that portfolio for it to be completely turned around. So you're absolutely right.
Perfect. I think there is one more question from Mr. Varun Bang. He's saying, unlike in last cycles, large banks have not transmitted interest rate cuts, especially on term deposits. Historically, SBI has led the transmission. How do you see situation evolving this time around? How long could it take this time? We had covered this thing, but maybe if you have any further thoughts, sir.
I think the specific comment may not be feasible, but for the industry, see, some lag would always be there. And all the large banks, I would say this is the same phenomena, whether it is bank like SBI or the private sector bank. So lag would always be there, and competition for the deposit doesn't go away. So it's not easy.
Got it. One more question, sir, which you can take. Again, it's related to sustainability. Mr. Amit Lamba, he's saying, is there a subsidized rate of interest for a company who is into construction of green and sustainable buildings? Mr. Sharma, can you take this?
Can you come again?
I'll repeat it. He's saying, is there a subsidized rate of interest for a company which is into construction of green and sustainable buildings?
See, the challenge with the banks face that when you raise the deposit, you want to call them green, then I as a depositor demand a little more. And when I want to lend, the demand is that you charge less. So jokes apart, the competitive landscape for the green lending is already very tight. Suppose if we were to extend money to renewable, people are not accepting anything above 8.5. There is a market. So already highly subsidized rate is there, whether this particular green renewal is there or the green building is there, already highly competitive rates are there in the market. So as we were mentioning, it has become business. So we want to have a good building. We want to have a good green portfolio. So all banks are keen. So already it is inbuilt. It is not coming as a specially consistent, but the market is after those assets. So market is automatically giving you a better rate.
Got it. Got it. Great. I think that brings us. I don't have any more questions. Maybe we can make one more call for questions. Okay, we have got one more. And this is for Mr. Ajendra Agarwal. What is your take on the substandard quality issues in EPC, which are more witnessed in the recent periods? What should be the mitigants around it? Ajendra ji, you got the question?
सर
Substandard quality issues in EPC. Maybe you can share your thoughts. Yeah.
वही वजह है जो मैंने मेंशन किया अर्लियर आल्सो कि जो रेट कट है अल्टीमेटली आपकी जो 60% मेटेरियल कॉस्ट है और 70% पे आपको अगर प्रोजेक्ट डिलीवर करना है तो कहीं ना कहीं कॉम्प्रोमाइज होगा। तो ये इस तरह की चीजें और गवर्नेंस ही इसका एकमात्र मतलब सॉल्यूशन है। बेटर गवर्नेंस इज द ओनली सॉल्यूशन और उसी की बेस पे अभी गवर्नमेंट काफी स्ट्रिक्ट एक्शन भी ले रही है क्योंकि जो कोविड के समय सर काफी कुछ रिलैक्सेशन दे दिया था गवर्नमेंट ने जो कंडीशंस के ऊपर, वो भी वापस गवर्नमेंट उस पर काम कर रही है और मेरे को लगता है अगले 4-6 महीने में उसके काफी अच्छे इम्पैक्ट आएंगे।
Okay. But you're saying that and as you mentioned, I mean, the quality issues may come back to bite you later. Sir, आपका आवाज नहीं आ रहा है, अजेंद्र जी. Sorry, your
एग्जैक्टली सर
हाँ, अभी सुनाई दे रहा है।
तो सर एक्चुअली ये सर कम प्राइस के ऊपर आपका जो डिलीवरी है वो पुअर है और अल्टीमेटली जो कंसेशनर है उसके ऊपर भी इफेक्ट आएंगे। जो प्रोजेक्ट की जो एन्युटी, क्योंकि गवर्नमेंट के जो प्रोजेक्ट्स हैं वो 15 इयर्स की डिफेक्ट लायबिलिटी के साथ में है, आपको अल्टीमेटली पेमेंट अगले 15 इयर्स में मिलना है। तो काफी कुछ चैलेंजेस है कंसेशनर के ऊपर और जो ये पुअर क्वालिटी के साथ में काम कर रहे हैं उनको काफी चैलेंज करने पड़ेंगे।
Okay.
आने वाले समय में गवर्नमेंट काफी टाइट एक्शन ले रही है और इसके ऊपर काफी काम हो रहा है सर।
The interesting thing is that a lot of people are also selling projects. So I think even the sovereign funds and private equity people who are buying these assets, they will have to be careful to buy an asset which has still got 10-15 years left.
भी कुछ टाइम में कुछ ऐसे डील हुई है जो पुअर क्वालिटी के प्रोजेक्ट्स हैं, तो अल्टीमेटली जो प्रोजेक्ट्स को ओन करेगा, जो भी एसेट को ओन करेगा उसको मुश्किलें लेनी है सर।
Great. So thanks a lot. I think we've run out of. There are a couple of more questions, but those are the topics. I think someone is still talking about NIMs on the bank's impact. So I think we've discussed that in fair bit of detail. So great. So I think we will kind of bring the discussion to a close. Thanks a lot for all the panelists for being very candid and sharing your thoughts. I'm sure with these insights, our audience would have certainly benefited. And we look forward to engaging with you once again. I'll anyways hand it over to Mamta. Mamta, can you kindly do a final vote of thanks, please?
Sure. Thank you, Sachin, for moderating the session and Smita for your presentation. Once again, thanking all our guest speakers for their insightful views. It was a privilege to host you. And lastly, thank you to all the participants for taking the time out and being a part of this CareEdge webinar. For any further queries, feedback, or suggestions, please write to us in the feedback mail. Goodbye for now. Requesting the tech team to kindly log off.